There's a camera up there. It goes from. Turn my laptop. No, this camera. Right? All right. Good morning. It is 11 o'clock Thursday, December 21st, 2023. We are live here at our office in Eden Prairie. Thank you guys all for being here today. I appreciate you taking the time out of your busy schedules during this busy holiday season. We are also live online on our website, on Facebook, LinkedIn, YouTube, Twitter, wherever else. So if you are online with us, thank you for taking the time out of your busy schedule to be here with us today. And then we are also recording this. So if you're watching this in the recording, a special welcome and thank you to you as well. All right. If you are new here, my name is Eric Hagan. I'm a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, who we will hear from in just a minute. Financial advisors Dan Oshman and Rana Grant. If you are a guest of Dan or Rana, thank you also for being here today. And then our client support team, John Knutson and Marilyn Westmark. Together, our goal is pretty simple. We want to help all of you make your next financial decision, and then the one after that, and the one after that, and the one after that, a good one. So today, we're going to dive right in to our capital markets update and outlook. This is a monthly check-in presentation that we prepare and deliver. We're going to hear from our Chief Investment Officer, Tom Fox. He's going to talk about the headwinds, the positives, and he's also going to give us a special outlook today, which is our 2024 stock market and economic outlook. Tom has a very impressive resume. So you can see on the screen, decades in the business, a lot of different accolades. You can see on the screen there. I'll run out of breath if I read all of them, though, Tom. So I'm not going to do that today. And I thought I'd start today by taking us back a little bit down memory lane, if you will. This is the slide from a year ago, December 2022. And if we all recall, the drum beats were deafening at that time that the stock market was going to crash, that we were going to have a massive recession, and that it was all doom and gloom. Anybody remember that? Tom stood up here and said, no, that's not going to happen. We're going to have a soft recession if we have one at all. We're going to have corporate earnings come down, but no crisis. It's going to be a bumpy ride the first half. Did we have a bumpy ride the first half? Yeah, we did. Didn't we? A high probability of double-digit returns, right? S&P 500 forecast 4,600 by the end of the year. We today are at roughly 4,730. Can't get a whole lot closer than that, but definitely the minority in the projections of what was going to happen in the year. And then lastly, down there at the bottom, explosive upside in stocks happened maybe a little bit later than maybe we were expecting, but it did happen. So I put a check mark there. So that being said, we want to pay attention to what Tom has to say, particularly when we look forward to another year, 2024. So with that, no pressure.
No.
Tom, thank you so much for being here. Appreciate you as always. Yeah.
Yes.
Let me progress.
Now, I get really prideful or arrogant about that call, but I've learned in the business you get humbled very quickly. And so I'm not going to get overly excited about that. We were very accurate. In fact, we stood alone. I was on that pirate ship on the end of the plank. And just maybe one other manager that I know forecasted that high in the S&P. Now, there were a number of adjustments about halfway through by others that were bearish. So we're standing alone. And fortunately, I didn't have to jump into the Shark Tank. This year could be a different story. But our theme for 23 was wag the dog. How many remember what that is? Where something of lesser influence influences something of greater influence. In this case, inflation would move the Fed. And guess what happened? In a big way. They pivoted, surprised everyone. That's why we've had the rally in stocks and bonds. And that was not expected by most, but it did happen. It took a little longer than I expected. I expected it to happen a little earlier in the year, but it finally arrived. the dog was wagged. So that's pretty exciting. All right. So let's look at the combination of things. We always like to put the wall of worry. Now I've taken off growing uncertainties because I've removed several uncertainties. And this is when the Fed Chairman Powell came out and surprised everyone. And the dot plot, which is the forecast of each Fed president, showed that they're not only going to do 2 cuts next year, but 3. And they became from hawkish language all the way through to semi-dovish. And so that changed everything. But we still have a number of things. You can see we took off. Fed will keep rates high for a long time. That's been this. How many have heard that on the cable news? That changed in one moment when Powell came out and spoke. Fed still looks talking hawkish language. They shifted. That's gone. These are huge, very big statements that are going to change everything. And of course, where the direction of the stock market goes, where bonds go. Now, we still have issues. We have the Israeli-Gaza war going on, but that could begin to expand. And it's already showing signs with the Red Sea being attacked on a regular basis. That could expand into something bigger. So the geopolitical risks, I think, are very high. We're going to talk about that in my outlook. And then business debt coverage. We talked about this last time. It's costing small companies a lot of money to fund their needs for their companies. And you can see the interest rate was 4.65 they could borrow at. Now it's over 9%. Now, hopefully that's going to start coming down. But the Fed hasn't, you got to remember, the Fed said we're going to. They haven't yet moved interest rates, which means it's still restrictive. So the rates haven't been touched. And so the question is, when are they going to do that? Is it going to be in March? Going to be in June? Somewhere in between? We don't know yet, but it's still going to be a while before that happens. Okay, sluggish economy and China's having troubles. They're having all kinds of problems there with their real estate market, and it's impacting everything. If you're a Chinese employee, person, family, and you've been saving money and put it in the Chinese stock market, you put it in real estate, you bought some extra properties because you thought real estate was going to go up. And there's 3 different, I can't remember the third one, but there are 3 different impacts on the normal Chinese family because they invested in those 3 areas, and all 3 have come down significantly. So they're all hurting. So it's a real problem. Plus, there's tons of unemployment for the young people. Right now, the unemployment rate is skyrocketing for the young people. And when people don't have work to do, what do? They cause problems, right? And so I don't know what the Chinese government's going to do to employ all these people, but there's a big problem. Big refinance problem coming in commercial real estate. I don't think that gets any better next year. We have all this commercial real estate. It's not full, high vacancies. And now they have to refinance their low interest rate with higher interest rates. That's coming in a big way in 24. So we think that's a big problem. Historically, Fed interest rate campaigns to tame inflation ends in recession. And we're going to talk more about this. Now, this is generally the wall of worry. I haven't always agreed with this wall of worry, but I am starting to agree with some of it. And we'll talk about which components I'm agreeing with. Yield curve has been inverted, still inverted, and 100% of the time, within 12 months or so, you end up in recession. So is that going to pan out again, or is it going to be an anomaly? We don't know yet. But it points to a recession, the delayed impact of global interest rate campaign. So this is the lag effect. We think there's going to be a lag effect with these high interest rates, and it's going to hit the first and second quarter of 24. We're going to look at that, but we agree with that. Also, many strategists have been negative all year. And so what's driving this rally? Well, the Fed's pivot. And also people were short the market. I think 178 billion. I just read this a minute ago. um, was lost because of shorting the market. So many people, hedge funds, institutions, individuals shorted the market and they got burned and they've lost about $178 billion. We've been bullish. Many people have been bearish. So they're burned by the market. They're going to have to catch up maybe until the end of the year. Santa Claus rally's coming and we'll look at that. So, but I want to just point out how negative the fund managers have been. Now, this is the large cap managers year to date. 65% of the large cap managers underperformed their benchmark. They didn't meet or beat the benchmark that was assigned to them. And the reason is because they've been bearish, had a lot of cash, and they didn't reinvest that into stocks. And so they're way behind. What's interesting is that those managers that 65% that underperformed their benchmark did so by 6.5% on average. That's a big number. They're under their benchmark by 6.5%. And that is, in view of that, it's saying that there was a lot of bearishness in the market. So there could be a catch-up trade right now going on into the year end. We'll look at that in the positive. So this is the negative. We've cut out some big ones, but we're going to look at in the next slide. Positives, why you should own stocks today. Well, the inflation trend is downward, and we're going to look at an inflation number tomorrow. The PCE comes out, which is the Fed's preferred inflation rate. We'll talk about that. The Fed pivot arrives. Policy view goes from hawkish to semi-dovish. Fed plot increases. Their dot plot increased to 3 cuts. They're saying, hey, we're now talking about cuts, and we're going to cut more than 2, which was before, and now we're going to cut 3. That ignited again the bond and stock market. And they're open to the idea. Rates fall dramatically, set up rally in stocks and bonds to year end, which we have been saying would happen, and it's happening. Stocks outside of FANG are not expensive. If you look at this is a positive because there's still groups we could go to, especially and we have in our thematic, we have groups like Quality Dividend or Equal Weight S&P 500 that have now started to outperform a little bit. And so the general market. So we think in my view, the top 7 stocks that are driving most of the performance this year, which we own quite a few, will probably lag next year, at least the first half. And we'll talk about that. So the U.S. consumer overall, if you look at the debt service on a long-term chart, how much debt are they carrying? It's not too bad. So it's not overly high. So there seems to be that the consumer is still healthy. The subprime consumer is not, especially when it comes to consumer loans like credit cards and autos. There's a lot of repos that are going on, and there could be a shift to even a greater repo situation coming in the future. Now we've had a lot of stimulus. We've had a lot of excess savings over the period since the pandemic, and people saved up. That money is now gone, and what people are right now shifting from their savings or their stimulus money to credit cards. How many know where that ends? It doesn't end well, but that's what's going on right now. Another good point is 70% of the mortgages out there are under 3%. Nobody's moving. Nobody's changing course. And the reason is they don't want a high mortgage. They're getting sub 3%. Why would I move? So there's a lot of influence not to move. I'm sure families would like to move up to another house or somewhere else, but they're kind of stuck right now. I wouldn't want to be in the real estate business right now. All right, so Fed is done. Huge amounts of cash on the sidelines will bolster the stock market and bond market to the end of the year. We see it strong all the way to December 31st. This year, Santa Claus rally is still ahead of us. That's the last week. Typically, you get a big rally in the last week after Christmas, starting Christmas, before Christmas and to the end of the year. We think that's still coming. And then FOMO. People are trying to, and performance chasing. They're going to try to catch up. There's a lot of managers that missed this this rally all year, this bull market, and they'll probably try to capture a little bit as we head into the end of the year. So we think that's going to happen. Overwhelming number of investment strategists have been bearish, missing the bull market, starting to get back in the market, catch up trade, covering their short positions. And again, I just read just a few minutes ago, 179 billion was lost because people were negative on the stock market and shorted it. Now, a short the stock market means you borrow the stock and then you pay it back. And if the stock goes up, you got to pay more. So you actually lose money. What you're hoping for is that the market goes down and then you make money. It's inverse of just owning stocks. And so many people, because of their bearish view, I mean, really smart people, smarter than I am, have been short or bearish all year.
Sounds like we got to give him some more credit. All right. 2024 theme.
All right, here we go.
Drum roll.
I gotta
Thank
go.
you.
I gotta go. I gotta catch
Gotta
up.
go.
Yeah, here it goes. We were pretty accurate last year. Actually, we called the S&P now 2 years in a row with that very pretty narrow range.
Pressure's on.
Here's my theme for 24. How many recognize this song? Bob Dylan. The times there are changing. So I see multiple changes this year in the market and the economy. So that's our outlook and that's our theme. So I'll bother with, like I did Wag the Dog. I'm going to bother you every month with that. All right, here's my outlook. I'm going to put it up front and then we'll look at charts afterwards. Here's my outlook. First half, disinflationary trends continue, deaccelerating growth picks up steam. I see the economy is going to slow down and inflation's coming down. And we think that's going to happen in the first, second quarter. Impressive resilience of the US consumer begins to fade. So we think the consumer, which has been spending, they're 70% of the economy. They're holding up the economy right now. We think there's going to be a times or a change and things shift and they slow down. Because when they're moving from excess savings to credit cards, that only lasts so long. And I think it happens after the Christmas buying spree when that's over. So they become less of a growth driver next year. And we see that happening. Excess savings, financial stimulus come to an end. Households become strained by the current high interest rates. Remember, the Fed hasn't lowered rates. It's still restrictive, very high. Economy slows, unemployment rises, corporate earnings start to slow, and in the first and second quarter. So this is the part one. First half, this is what we see coming. Number two, the economy goes into a mild recession, but it avoids a heavy recession. And there's some reasons for that. We think it will be a technical recession occurs. 2 negative quarters of GDP, maybe first and second quarter. The Fed cuts rates and attempt to slow the bleeding in the economy. Fixed income takes center stage, and we're going to see the 10-year rally. Rates are going to go down. We have a forecast here of 3% or less. We see the 10-year going 3% or less. So what happens? Stocks go into correction because of the economy rolling over. Possible bear market. Now, correction is minus 10% from the peak. A bear market is minus 20% from the peak. So we think it's going to be around 15%. Bonds outperform stocks. This is the first half. And then S&P 500 index goes to 4,100. And we're what 4730, somewhere in there. So it drops maybe 15+% from where we are today. So that's where it ends. So I'm not only calling the end of the year, I'm calling half. I'm getting, micro.
You really put your neck out there.
Yeah, I'm in trouble. All right, first half? So second half, what happens? Stocks discount an economic recovery. The bad economy, slowing economy in the first half now turns around. And remember, the market discounts to the future. So the market always moves ahead of the economy. And so we expect that stocks will start to move before the economy turns around. Typically, the bottom of a A stock market is maybe 1/3 of the way through a recession. It's already starting to say, hey, Fed's gonna make some lower rates. Remember, Fed has been doing quantitative easing at the beginning. Now they've been selling their bonds. They could stop selling their bonds and they could actually go the other way. The Fed now has tools. They can lower rates. They can start not sell bonds anymore, treasury bonds, and they can also even buy some if they need to. So there's a lot of tools in their toolbox. Economy recovers, corporate earnings rebound, stocks outperform bonds. So I've got bonds outperforming the first half and stocks outperforming the second half. S&P 500 index and second half at 5,100. Now I looked at a lot of forecasts out there because all the forecasts are now out there. So we're kind of in the middle of what the forecast is, but we see a big dip and then a recovery to the end. So, but overall, we're only talking about from where we are today or year end, about a 6 or 7% total return. Now, bonds in the first half could do 10%. 10-year treasuries could be up 10%. Inflation reaches Fed's target of 2% or even lower by the end of the year. So that's what we see happening. So we have two halves. Bad for stocks, good for stocks, good for bonds. Bonds will probably be neutral in the second half. They'll be fine, but stocks will outperform. So what's going to happen is based on this forecast, we're going to adjust the portfolios to take advantage of this particular scenario. Now, let's say I'm wrong, and let's say most economists are saying soft landing next year, and we're saying it's going to be harder than a soft landing. If we're wrong, bonds still do well, and stocks hang in there. So we're going to take a percentage off the equity side and put it into treasuries, probably the 7 to 10-year treasury. And we've been talking about that, making a plan for that. So we're going to take some risk off the table. Now, if I'm right and stocks go down, the treasuries are going to go up. So they'll be counterbalanced. Remember in 2022, stocks and bonds went together. Stocks down 18, bonds down 13 or more, almost as much as stocks. Now there's the protection that was back historically. We'll see a protection by having an increase in that the whole bonds as bond yields come down. So, and also we think the Fed's target tomorrow, this PCE, they're saying the trailing 6 months PCE may be already at 2%. We'll look at a chart on that. So now I'm going to look at some charts.
And as I pull up the charts for you, just a reminder for anybody watching online, whether you're live or in the recording, I am monitoring the comments section. If you have a question for Tom, feel free to put it in the comments section, and I'll bring that up to him when he gets through these slides here. There you go.
Okay, so what will fund bond rally in the first half and stocks in the second half? This is where it's coming from. Look at how the money market funds, assets under management have grown significantly this year. So everybody's gone into the money market fund. Look at historically, all the way back to 2007. This is money in cash, earning 5% right now, but that number is going to start coming down. As rates continue downward, the money market, short-term money market yield is going to begin to drop. And so when that starts coming down, people are going to say, hey, I can't get 5% anymore. Where do I go? And so they're going to start moving, we believe, to longer duration, away from short money markets to longer duration, like a 7 to 10-year treasuries or corporates. And so that's what they're going to do. They're going to move that. So this is where the money's coming from for the bond rally that's going to happen in the first half. That money also is going to go in the second half to stocks. So that's the funding mechanism we see. Now lagging, here's another thing, lagging stocks have started to show some turning around. The winner is again Magnificent Seven has outperformed everything. It's up 60 some percent. So you have Magnificent Seven on the far right in the last month since 12/14. 1 month returns to 12/14. You can see small caps and the S&P 500 equal weight has outperformed. Those have been big underperformers compared to Magnificent Seven tech stocks. So, and what is that? That's includes Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Those stocks are now showing cracks because they've run up so much. And so now they're starting to lag. But we see that rotation happening. You can see Quality Dividend, something we own in Thematic, is starting to pick up some steam relative to the other areas of the market. This is what we call market breadth expansion, where it's not just a few stocks, not 7 stocks or 10 stocks driving the indexes, but now other stocks will begin to participate. But the ones that were big winners last year will begin to diminish relative to the other stocks that are underperforming.
To that point, Tom, I heard yesterday the S&P 500 equal weight went from a 52-week low to a 52-week high in 33 days.
33 days.
Isn't that wild?
Yeah. So you can see,
Changes quick.
yeah, it can happen quick. And we think next year we're going to see that migration from the top 7. Now, the second half, it's all going back to the Magnificent Seven. And we'll talk AI. That by the end of the year, it will do well. But we think there's going to be that issue in the front end of the year. All right, core inflation. You can, I don't know if I can do this. I got it. You can see the core inflation, if you take out shelter, because shelter and used cars are a big percentage of the CPI. If you take that out, we're almost at 2% already. If you take out shelter just out of the equation, and shelter is showing signs of coming down. So we think that you can see where we peaked with this headline CPI, the core CPI, and then core less shelter. You can see that shelter is held up in terms of inflation, still coming down, but you can see what happens if you take out shelter. So if shelter comes down, you're going to see a huge drop in the CPI to the target that they're looking for, the Fed's looking for. Now, tomorrow's preferred inflation number, the PCE is coming out, and we'll be excited to look at that. There's a big expectation. I don't know if something's leaking, but they're saying it's going to go from here to here tomorrow. If that happens, that's going to be bullish for the stocks and bonds going into the end of the year, which says, hey, Fed's top inflation gauge is coming down even more, and it's at their target. So we're going to see what happens if that's true. But there seems to be today, I was reading, there seems to be a lot of opinions that this is going to happen, but we'll know tomorrow morning. Maybe I should have had this tomorrow afternoon, and then I would have already seen the number. But that's good news. You can see again how much inflation has come down from where we were. All right, so what happens 12 months before, where inflation's coming down, the Fed's talking about pivoting, but what happens when they do pivot? Is it June? Is it March? When are they going to pivot? And what happens the 12 months in terms of returns before they pivot? And then what happens 12 months after they pivot to the first rate cut? And you can see in the left side, I've circled it, stocks and government bonds. Those are the two we're interested in. Is that 12 months before stocks underperform, and look at government bonds outperform. They're still both positive. And then afterward, when it shifts from to after, you can see stocks outperform and bonds underperform, but still are positive. And that's really our scenario. So I think for the second half, the first half, I think bonds outperform the first half, stocks the second half. And this lines up with the expected rate cut of the Federal Reserve. You can see the other ones there too. So here we go. Market expects more rate cuts than the Fed. This is interesting. In 24, the market, the analysts are saying, hey, we're going to be at 3.8 for the Fed. The Fed's saying 4.6, 25, 3.6. There's the market saying 3.3, and then it inverts in 26. Both are coming down. So what does that mean? Rates are coming down. What's that good for? Which asset class? Bonds. When rates come down, bonds rally. And I'm expecting in the first half maybe a 10% return in intermediate treasuries. And there could be a lot more risks and volatility with stocks again in the first half. So this scenario, whether it's the Fed or market expectations, it is really saying that rates are coming down. All right, but there are cracks beginning to form in the labor market. So we're going to look at that. You can see labor market is starting to moderate. The job openings, payrolls, all heading downward. So all this is saying, you can see this starts in January 22. It's coming down, not fast, but it is coming down, and that's a direction. And there's momentum this way. We think that's going to continue. Okay, this is a complicated chart. If you look at the blue is always the same, maybe a different duration. The blue is the unemployment rate. What the reds are three different indicators that are highly correlated to the direction of employment or the unemployment rate. So the first one is the 1 year lead of the National Association of Home Builders. And you can see how correlated these are. And so you can see that it's jumped at where I circled, which historically, when that goes up like that, the unemployment rate goes up. And then we have the NFIB survey, percent of firms with one or more hard to fill jobs. When that goes up, so does the unemployment rate historically. And you can see that has jumping recently. And then the last one is quits, total non-farm rate, how many people are quitting. And you can see that's going up. That typically correlates with the unemployment rate. So we have three different gauges are saying that the unemployment rate is going to tick up. Now that we just had an unemployment rate and it was good. Actually less unemployment than it was expected. So that isn't here yet. We're talking in the first half, this begins to happen. So we think these are interesting indicators, gauges, where the employment is going. And if unemployment begins to tick up, that's when the Fed gets more excited to cut rates. Which means what? Bonds rally. Okay, level of Fed tightening suggests earnings will fall. Remember I said first half earnings are going to come down. Well, you can see how correlated this is. This is the 18-month lead of actual Fed policy minus the Taylor implied policy rate. How many know what the Taylor implied policy rate is? John Taylor, 1993, came up with a mathematical formula of where the Fed should set their interest rates based on inflation. And it's typically a target of around 2%. And the growth rates formulas in there, growth of the economy. But what it's showing, it's been a very high correlation of Fed. This is what you call the lag effect. Remember we talked about the Fed has already raised rates. It's already peaked. But there's a lag effect, an 18-month lag effect, or even less, of what will happen to the economy and corporate earnings. And so what this is indicating is that earnings, because this line is going down, earnings are going to come down. Now, I would say most forecasters are predicting that we've already troughed in earnings and they're just going to go up from here. We disagree. We think the fourth quarter will be fine, but it's the first in April. It's going to be in July when those numbers come out and we'll start seeing cracks. So we think, based on this chart, that there's going to be a slowdown in corporate earnings. Does that make sense? And it's all because of the Taylor rule ratio. No, I'm just. Okay. All right, so household delinquency. This is another 6-quarter lead of house affordability. How many know that house purchases right now is way up here in not being affordable? Rent's down here, but they're all kind of coming together. It's getting more and more expensive to own or rent a house or a place to live. And you can see when this happens, when the 6-quarter lead of housing affordability goes up this high, look how high it's gotten, that will tend to lead to mortgage delinquencies. We see that picking up some steam, following in the footsteps of autos right now and credit card delinquencies, mostly in the subprime area. But it's beginning, that usually starts there and then moves up the classes. All right, forecasts of unemployment. This is interesting. We disagree with the Fed. They think unemployment's going to level off at a pretty decent rate, be stable. Fed forecast is the dots. We see this going up higher and going beyond what the Fed is expecting, and that's based on our forecast. So we are disagreeing with Powell and the Fed presidents. Remember, I was in New York presenting to all the Fed presidents. So I got to do that one time. So I went into the Federal Reserve in New York City, right on Wall Street, through all the security. I was sitting outside, mahogany everywhere, marble floors. And there's these 2 huge doors that you walk into. And I was sitting there in my chair to present to 12 Fed presidents, all economists. I walked in there and the first thing I did was said this: the models that we're going to show you, we don't forecast the economy because we know you try to do that and don't do such a good job at it. That's my opening line. And they're, I mean, this is a stiff group of, got, ties and they all started laughing, and that was great. So I did get, that's my claim to fame. I got them all laughing, which was, oh my God. All right. Geopolitical problems. This is and oil. Right now, oil prices are what? Fairly low, $70 per barrel. You can see how it's come down. Oil prices keep falling. There's a number of reasons for that. And one of them is that the US, through the shale fracking, is producing a lot of oil right now. They're moving up to record high production in the US. OPEC is trying to get those prices higher, and they may succeed, but not yet. So let's look at the production. You can see oil prices. This is like a tax credit for the consumer. That's very good. Here's another reason why it's keeping from supply high, is this is our US production. That's at record highs. So we're producing more oil than we have historically. That's why, and right now there's an oversupply of oil, which means prices will stay down. However, we think things could change and change quickly. We'll go to the next slide. Global violence and conflicts are on the rise. You can see from 1946 where we are today. This is extra somatics. You can see all these intrastate, non-internationalized. I don't know what all those words mean, but what this shows is the number of conflicts going on in the world is increasing. And we expect this to be a problem. And right now, with the Houthis, or however you say their name, in the Red Sea, this is going to be a problem. The US is now putting a lot of assets. How aggressive do they get in the counterattacks? We don't know. It is going to create higher shipping temporarily, but not where we were in the supply chain before. I read today, there's about a 2-week delay now because of ships not wanting to go through the Red Sea. The US is going to try their best to fix it, but it could cause a greater thing. So there is a possibility that oil could jump up again. I don't think it's long-term, but we could see some spikes coming in oil. And this is going to be an issue. I'm predicting, forecasting, there's going to be more conflicts in 24 than even 23. So I think it's going to be expanding. So this could be a problem in all our scenarios. You can't predict geopolitical events. It's impossible. But you want them here in your quiver to how to adjust things, how to adjust portfolios if something did happen or seems to be happening. So this is something to look at. So there are some bullish, we could be wrong in the first half. Most people are saying it's going to be a good stock market all year. They're saying that we're going to have a very soft landing. The Fed's going to pull off the miraculous soft landing. We'll see. They haven't done it historically. And here's another good chart that shows that we're in the second year of a bull market from that October 22 low. And typically, the second year, which is the orange, does very well from the first. In fact, the average second year return for stocks is 12.6% after the first year of the beginning of a bull market. And many are saying we started our bull market in October 22. So what they're saying is it could be a good year based on that. Now, historically, it does seem to pan out. It's always positive the second year. Average 12.6. So that's a bullish indicator. Another thing is generative AI. That's going to change. It hasn't been incorporated into companies at the level it's going to be. And this is why we are bullish the second half on stocks, because AI will really get going in the second half of next year. And you can see this is interesting. This is the 1 year change in NVIDIA, which is the main kingpin of AI chips, and 1% change of output for all persons. So output is going to increase. What does that do? It causes companies to be more profitable. You don't need to spend as much on labor. It couldn't cause unemployment. There's many employees are worried that AI is going to take their job, and it eventually will. I think Elon Musk is saying hardly anybody will be working in the future because AI is just going to do everything for us. So I would buy leisure stocks, because what are people going to do? So this is another positive. A second year of a bull market is good, and AI could change everything. We think it's tilted towards the second half, not the first half, because of the economic situations going on. All right. So that's the end of my 2024 forecast. We're very accurate last year in December, hopefully be accurate this year. And the whole goal for Eric and myself is to really take this scenario, adjust the portfolios, and set them up for this kind of scenario unfolding. Now, we're data driven, so we're evidence-based driven. So if we see something that's not going in our forecast, then we will make the adjustments to modify. If you're a Navy SEAL, one of the key things in their success is being adaptive. So we will be adaptive. But this is our scenario today. Could all be changed tomorrow. Anyway, thank you for the opportunity.
Thank you very much, Tom. Appreciate all of that. With that, I'll open up to any questions. I see you guys online. If you're online and have a question, you can feel free to email me directly. I'll be watching my email. You can also post it in the comments section, and I see those as well. And I'd be happy to get that to Tom for you. But I think we have a question in the room here.
Yeah, in all of your factors that you mentioned, I don't hear anything about how the political or election year is going to factor into any of this.
Yeah, typically this is an okay year, this rest of this year. The year after, not so. I don't put much weight on the political side because it varies, Republican, Democrat. In fact, I'll have to look at the numbers of the year of the election and the year after, but I don't really put a lot of weight on that. I know that it's something to think about. I've got some research on it, but I don't think it's a super accurate forecast or indicator. Because it can go either way.
So referring to your last slide on the AI. So if people aren't working, how do they make a living and buy this leisure time?
That's what I'm gonna have you figure out. That's a good question. What you want to do is be able to program AI or to run AI. There are going to be human beings in there somewhere. It's a long time before that starts impacting. But the first step is productivity increase in companies. Companies are going to become more profitable. They're going to produce more per employee than they have in the past. So, and we're at the beginning of that. They're still trying to figure out, companies are still trying to figure out how to incorporate it. Software will have to be developed and built for each type of sector of industry they're in. But it's going to impact all areas, and it will be probably starting, you'll see the beginning of that in the second half of 24 into 25 and 26. But there's a lot of forecasts out there. I'm not sure, where it all ends up. Otherwise, we'll be in some Caribbean island somewhere. That's all I know. Yeah, on the computer, just clicking away.
Will they be able to, we'll be able to do our plumbing and electrical
Exactly, right?
No, those
failures and stuff like
Well, yeah,
that?
the robots come in.
Yeah.
Right? Yeah, maybe the robots come in and change your toilet or whatever. And yeah, painting, I don't think that's going to happen. So the laborers, I think, will be fine. It's just the people working behind white collar desks.
Invest in trade schools.
Yes, trade school's probably going to be okay. I think we're a long ways before a robot can paint your room. Although Elon Musk has got his robot, I don't know when he's going to launch it, but he's got it.
He's working on it. Yeah. And he made the comment about AI taking away jobs, but he didn't really fulfill that the answer to that question.
Yeah.
What everybody's
Yeah.
going to be doing.
Yeah.
So making headlines
Yeah.
for sure. Right. Any other questions in the room? If you're online, if you have any questions, feel free to post them on there. We'd love to field them for you. If you're watching in the recording and you have a question, you can also post it. I do get those, and we would love the opportunity to circle back with you. This is your opportunity to look over our shoulders, kind of get a feel for where Tom and the team here thinks things are going. We want that full transparency, that full clarity, and the knowledge that we are paying attention. And we've been talking for weeks now. What changes may occur as this forecast has been developing, and what we're planning on doing the first of the year. And like
Yeah.
you said, that can change, but we do have a plan. We've been talking about it for a while now,
Yes.
and
So we'll probably be taking risk off somewhere in early January, maybe the first week, second week, I don't know yet. But we got a plan. So your portfolios will be adjusted to the plan.
Yeah.
And we got to look at the data that comes between now and then and see what if more cracks are plugging.
And with that, if we're not investing your life savings for you, I encourage you to go check out smartmixportfolios.com. If you are a guest here today watching live or in the recording, you can learn all about our different strategies and how we put together custom portfolios for individuals, couples, families. You can learn more about that process at smartmixportfolios.com. With that, I don't see any more questions. You guys have any more questions? All right. Well, we'll go ahead and do one more plug here. So save the date. It's not on the website yet. It will be soon, but we are planning to be live in person Thursday, January 18th. We will get started promptly at 11 o'clock again, but we will not be at our office here in Eden Prairie. We'll be at Oak Ridge Country Club in Hopkins. I will do my best to live stream that. If I can't live stream it, I will do my best to record it and get it on the website later. But we do want people to show up. So we'd love to have you out. It's gonna be a wonderful lunch. We did a halftime report summer of 2022. It'll be just like that format. We'll have the presentation. We'll bring out a very nice lunch for everybody. Thought it'd be a great way to kick off the year. We'll also spend a little bit of time looking at the strategies and how they did for 2023. So obviously the year isn't over yet, so we don't have those final numbers. Things are looking pretty good. So we look forward to reporting that for you. So with that, I'll sign us off. And again, thank you, everybody, for being here. I know it's a busy holiday season. Hope you guys have a wonderful rest of your holiday season. And thank you again, Tom.
Thank you.